Bismillahirrahmanirrahim. So we have learned in the past videos and a playlist of capital budgeting in the channel. We learned about this chapter. So this is an overview of the total chapter, the capital budgeting, how we make decision to choose project. Overview of the capital budgeting process. Project with cash flow more than 1 year. As you know that the capital budgeting is the process of evaluating capital projects with the cash flows over more than 1 year. So these projects are long-term projects. 4 steps we have discussed already detailed in the video. The 4 steps of the capital budgeting process are: generate investment ideas. First step is generation of investment ideas that come from the public, from employees of the firm or company or any industry, and as well maybe they are employees, top management or low management. It depends on the project nature, and they may be customers. So investment ideas come from the public. Second step, analyze project ideas. So project ideas that come from the public or any other sources. So analysis of the project ideas is necessary, and then the project that is most beneficial and comfortable to launch the project. So this project selected from the project ideas. Third step is new product or market development. So expansion projects and new product or market development. And 4 is mandatory project complying with CSR. Mandatory projects to meet environmental or regulatory requirement. This is most necessary that project should be comply with the regulatory requirements and should be meet the environmental requirements by the government or agencies. And fifth one is other project such as research and development, and other project maybe fourth is here. Mandatory project complying with CSR, complying with the regulatory authority, environmental friendly project should be environmentally friendly. And other projects such as research and development are pet project of senior management. So link of this video you can see on the I button. Click on the I button in order to check the detail of the 4 steps of the project. So once the project ideas are generated and when we choose the project to launch or decision, so decision based capital budgeting decision should be based on incremental after tax cash flows, the expected difference in after tax cash flows if a project is undertaken. Sunk cost that is already incurred, that costs are not considered, but externalities and cash opportunities cost must be included in project cash flows. Sunk cost should not be included, but other externalities cost should be included in the project. So acceptable independent project can all be undertaken. independent project can all be undertaken. It depends on the financial resources of the company. While a firm must choose between or among mutually exclusive project. So the project that which is most beneficial for the company, that will increase the value of the firm, that project should be accepted or choose between one or more projects in mutually exclusive projects. And so here is the all about decision making. Project sequencing concern the opportunities for future capital project that may be created by undertaking a current project. If a firm cannot undertake all profitable projects because of limited ability to raise capital, the firm should choose that group of fundable positive NPV projects with the biggest total NPV. Keep in mind, with the biggest total NPV of all the project, that project should be chosen by the firm, company, individual investors or traders. So the net present value, you can check the link in the I button with detailed video, the calculation, the interpretation, how to calculate in Excel. Video link are in the I button. You can click and check out the net present value. Net present value is the sum of the present values of project's expected cash flow and represent the increase in firm value from undertaking a project. Positive NPV project should be undertaken, but negative net present value project are expected to decrease the value of the firm. And second tool is financial tool, that is the internal rate of return. The internal rate of return, you can check link in the description below, and in the I link you can check the detailed calculation method interpretation of internal rate of return. As you know, the internal rate of return is the discount rate that equates the present values of the project expected cash inflows and outflows, and thus is the discount rate of which the NPV of a project is 0. A project for which the internal rate of return is greater, less than the discount rate, will have an net present value that is positive, negative, and should be accepted, not be accepted. So IRR is again the best method to choose the project. And the third tool is the payback period. The payback period, you can check the detail in the description link, and as well as on the I button you can check it. The payback period is the number of years required to recover the original cost of the project in present value term. So if you can check the in present value term, we will consider the payback period discounted, the discounted payback period. Both methods are given in the description in order to check the detail, and as well as the I button you can check it. The discounted payback period is the best because it considers the inflation, and the simple payback period does not consider the inflation or discounted cash flow. Simple cash flow taken in the payback period, and discounted cash flow period taken in the discounted payback period. So the next tool is the profitability index. The profitability index. The profitability index is the ratio of the present value of project future cash flow in the initial cash outlay and is greater than 1 when a project NPV is positive and less than 1 when NPV is negative. So profitability index detailed video in the I button and as well as mentioned in the description below. You can check it in the description. So the next tool is we have described in detail in the description link and as well as in the I button. You can check it. The next tool is the NPV profile, the net present value profile. An NPV profile plots a negative NPV as a function of the discount rate and it intersects the horizontal axis NPV equal to 0 at its IRR. If two NPV profile intersect at some discount rate, that is the crossover rate, and different projects are preferred at a discount rate higher and lower than the crossover rate. Higher and lower than the crossover rate. So crossover rate is our you can see it is the crossover intersection and it is the benchmark. And the next is NPV and IRR. For projects with conventional cash flow pattern, the NPV and IRR method produce the same accept reject decision. In conventional cash flow, in conventional cash flow, both NPV and IRR produce the same result. But in non-conventional, the cash flow pattern can produce multiple IRRs or no IRRs. So NPV is the best method in non-conventional. And mutually exclusive project can be ranked based on their NPVs, but ranking based on other method will not necessarily maximize the value of the firm. So geographically usage is that small companies, private companies and companies outside the United States are more likely to use technique simpler than net present value such as payback period. The net present value method is a direct measure of the expected change in firm value from undertaking a project. So this is a little bit this is a overview of the capital budgeting decision making process, and you can check all the detail in description and I buttons and end of the screen. So this is all about capital budgeting process. Next we will solve some problem of the net present values IRRs question in order to understand more easily, and also we will check our concept that have we discussed in the playlist of capital budgeting process. Thank you. So here is an request to all students and other viewers to please subscribe, like and share. Thank you. Bye bye.